So let's look at some questions here. Which of the following is considered a liquidity ratio? Would it be profit margin, asset turnover, receivables turnover ratio, or times interest earned? The receivables turnover ratio measures how many times on average a company collects its receivables during the year, and this is an example of a liquidity ratio. How about this one? Which of the following is considered a solvency ratio? There were two solvency ratios we talked about. The times interest earned ratio compares the interest payments with the company's income available to pay those charges. Let's now look at example 12.5. The 2018 income statement of Adrian Express reports sales of $19,310,000, cost of goods sold of $12,250,000, and net income of $1,700,000. The balance sheet information is shown on this slide and the next slide. So, our job is to create the various ratios. The receivables turnover ratio, the average collection period, inventory turnover, average days in inventory, current ratio, and debt to equity ratio. So as you see here, I want you to feel free to go back and forth. The receivables turnover ratio will take the $1,900,310,000. What did I do wrong here? The receivables, the $19,310,000, and divide that by the accounts receivable of, the sales of $19,310,000, and then we're going to take the beginning accounts receivable, the ending accounts receivable, and divide that by 2. So if we take our sales divided by the average accounts receivable, the receivable turned over 14.3 times. Now again, to figure out the average collection period, we're going to take that receivables turnover ratio, take the 365 divided by the receivables turnover ratio to figure how many days it took to collect. The inventory turnover ratio is the $12,250,000, which is the cost of goods sold, and that is being divided by the $1,500,000 plus the $2 million, which is the in your assets, the ending inventory balances. Take that, divide that by 2 to come up with an average inventory balance. To show inventory turnover of 7 times. To figure out the average days in inventory, you're going to take the 365, divide that by the inventory turnover ratio to come up with the 52.1 days. Current ratio is current assets, divide that by current liabilities. So our current assets are going to be the $700,000 cash, the accounts receivable of $1.6 million, and your inventory of $2 million. So that, and the current liabilities here are $1,920,000. So you take the current assets, divide that by the current liability, give you the ratio of 2.2 to 1. Debt to equity, again your total debt divided by your total equity, gives you the 88.5%. Let's look at ratios to analyze the profitability of a company. Now, the various profitability ratios are shown here on this slide. It summarizes 6 profitability ratios we've looked at, and then the various chapters in which we've discussed them and how we've calculated them. Now, these 6 ratios on profitability primarily measure the success of a company. We're going to go over each of these ratios. They measure the earnings or operating effectiveness of a company. Not only is it profitably necessary just to survive as a company, it's the primary indicator used by investors and creditors in helping to make financial decisions. Now, the gross profit ratio indicates the portion of each dollar of sales above its cost of goods sold. We calculate this ratio as gross profit, which is net sales minus cost of goods sold, and we divide that by sales. Gross profit ratios vary by industry. This slide presents the calculation of the gross profit ratio for Under Armour and a comparison with Nike. With a gross profit ratio of 49%, Under Armour sells its merchandise for about twice what it costs to produce it. While with Nike, they have a gross profit ratio of 44.8%, which means Nike's gross profit is still high, but it's not as high as Under Armour's ratio. Now, the return on assets measures the income the company earns on each dollar invested in assets. We calculate it as net income divided by average, not the ending total assets, but we average them. Average total assets are calculated as beginning total assets plus ending total assets divided by 2. This slide provides the calculation of return on assets for Under Armour and a comparison to Nike. Under Armour earned a return on assets of 11.3%, which is lower than Nike's return of 14.9%. Now, in a previous chapter, we learned about the various components of return on assets, but we can further separate return on assets into 2 ratios, a profit margin and an asset turnover. Some companies like Saks Fifth Avenue rely more on high profit margin, while other companies like Dollar General rely more on asset turnover. Investors are especially interested by companies that can obtain both high profit margin and high asset turnover. So, for example, Apple introduced several popular products such as the iPhone and the Apple Watch that generate both a high profit margin and a high asset turnover for the company. Now, profit margin measures the income earned on each dollar of sales. We calculate it by dividing net income by net sales. This slide provides the calculation of profit margin for Under Armour and a comparison to Nike. Under Armour has a profit margin of 6.7%, meaning that for every dollar of sales, almost 7 cents goes towards net income. Nike has a higher profit margin of 9.7%. Now let's look at asset turnover, the second factor influencing the return on assets. This measures sales volume in relation to the investment in assets. We calculate asset turnover as sales divided by average total assets. This slide presents the calculation of asset turnover. Under Armour's asset turnover is 1.7. Under Armour generates $1.70 in sales for every dollar it invests in assets. Nike's asset turnover is just a little bit lower at 1.5. Now, return on equity measures the income earned for each dollar in stockholders' equity. Return on equity relates net income to the investment made by owners of the business. The ratio is calculated by dividing net income by average stockholders' equity. Average stockholders' equity is calculated on beginning stockholders' equity plus ending stockholders' equity divided by 2. So this slide shows the calculation of return on equity. Under Armour has a return on equity of 17.3%. Its net income is 17.3 cents for every dollar invested in equity. Nike has an even higher return on equity of 24.6%. Nike's return on equity, return on assets is 3.6% points higher than Under Armour's, while its return on equity is 7.3% points higher than Under Armour's. This is because the financial leverage, the amount of debt each company carries. Recall that Nike has a higher debt to equity ratio. Remember, debt can be good for a company as long as the return on investment exceeds the interest cost of borrowing. Both Under Armour and Nike enjoy returns well in excess of the interest cost on borrowed funds. By carrying greater debt, Nike is able to provide a higher return on equity in relationship to its return on assets, further benefiting the investors of the company. The price earnings or PE ratio compares a company's share price with its earnings per share. The PE ratio is an indication of investors' expectations of future earnings for the company. So this slide shows the PE ratio for Under Armour and for Nike. By the end of 2014, Under Armour's closing stock price is $67.90, and the company's reported earnings per share for 2014 is 98 cents. This represents a PE ratio of 69.3. The stock price is trading at 69 times earnings. In contrast, the PE ratio for Nike is 25.2. Stocks commonly trade at a PE ratio somewhere between 15 and 20. At 69.3, Under Armour has a huge, high PE ratio. It looks as though, at least at this point in time, investors are more optimistic about Under Armour's future earning potential than Nike's, as shown by the price which they're willing to pay for Under Armour stock. As we talked about earlier, investors pursue two basic types of stock investments. They want growth stocks and they want value stocks. Growth stocks like Under Armour have high expectations of future earnings, and therefore they trade at higher PE ratios. Growth stocks are said to be great stocks at a good price. Value stocks have lower share prices in relation to their fundamental ratios, and then therefore trade at lower, or like bargain deals, PE ratios. Value stocks are said to be good stocks at a great price. Remember, profitability ratios measure the earnings or operating effectiveness of a company over a period of time, usually within a year. Investors view profitability as the number one measure of a company's success. Let's look at exercises 12.7 and 12.8. So we've got the various information for Plaza Screens Corporation. We also have here information that the net income is $184,000, sales on account are $1,890,000, and cost of goods sold is $1,394,250. we're going to calculate the various receivables turnover ratio, inventory turnover ratio, the current ratio, the asset test ratio, the debt to equity ratio. When you compare the companies, can one have a higher current ratio while the other has a higher asset test ratio? Then for the next one, we're going to calculate various profitability ratios. So as you see here, the receivables turnover ratio, you can go back to the slides to see exactly how we're coming up with these figures. The 1,890,000 would be sales divided by the beginning accounts receivable plus the ending accounts receivable. Divide that by 2. The inventory turnover ratio, again, cost of goods sold, divided by the beginning inventory plus the ending inventory, divided by 2. The current ratio, or would be current assets, divided by current liabilities. The asset test ratio is much more conservative. It does not include prepaids and inventory. So if you go and look at the current assets, we've got the 242 plus the 98 plus the 5,000 in investments. We keep out the inventory in order to calculate the asset test ratio. The debt to equity ratio here is 20.3%. As you see, one company can have a higher current ratio while the other has a higher asset test ratio. The company could have a higher current ratio due to higher inventory and prepaid expenses. Inventory and prepaid expenses are not as liquid as other current assets. So when we're dealing with the asset test ratio, we leave those out. Then as we move on to the various profitability ratios, take a moment and look through these various ratios. One company can have a higher return on assets, while another company has a higher return on equity. The return on equity takes into consideration leverage, the amount of debt the company's assumed, where the return on assets does not consider the effects of leverage. So the sports zone reports net income of $50,000, net sales of $500,000, and average total assets of $400,000. What is their asset turnover? Why don't you take some time and see what you get there? If you take the $500,000 of sales, divide that by the average total assets, our asset turnover would be 1.25 times. So the sports zone reports net income of $50,000 and sales of $500,000 and average total assets of $400,000. What is the profit margin? If you take the net income of $50,000, divide that by the sales, we get 10% as the profit margin. The sports zone reports net income of $50,000, sales of $500,000, and average assets of $400,000. What is their return on assets? $50,000 divided by our average assets gives us return on assets of 12.5%. Investors are interested in whether earnings will remain strong and in the quality of those earnings. We're going to examine these topics in this section here. We're going to distinguish between persistent earnings from one-time earnings. So to make predictions of future earnings, investors look for the current earnings that will continue or are persistent to future years. Some items that are part of net income in the current year aren't expected to continue. We refer to these as one-time income items, such as discontinued operations, discussed below in the next slide, are going to be an example. So when using a company's current earnings to estimate future earnings, we really need to look and exclude those items that are discontinued operations. So a discontinued operation is a business or component of a business that the organization has already discontinued or plans to discontinue. For example, Nike reported a $21 million gain on discontinued operations in a previous year related to the sale of Cole Haan, which is footwear and handbags, to another company called Apex Partners. We report any gain or losses on those discontinued operations in the current year, separately from gains and losses on the portion of the business that will continue. This allows investors to the opportunity to look at those and to exclude discontinued operations in their estimate of income that's going to continue on into future years. Based on a recent FASB standard, only disposals of businesses representing strategic shifts that have a major effect on an organization's operations and financial results are reported in discontinued operations. Examples include a disposal of a major geographical area, a major line of business, or a major investment in which the company has significant influence. Let's look at an example here, Federer Sports Apparel, which has two business activities, a very profitable line of tennis apparel and a less profitable line of tennis shoes. Let's say during 2018 the company decides to sell the tennis shoe business to a competitor, and the total gain from the discontinued operations is $1.5 million. We report the gain net of tax, which means that the $1.5 million gain before tax less the $500,000 in related taxes is reported on the income statement as a $1 million gain. This slide shows the income statement presentation of the discontinued operations for Federer Sports Apparel. Now, the sale or disposal of a significant component of a company's business, which is a component that has a major effect on the company's operations and financial results, is recorded as discontinued operations. However, the sale or disposal of most assets is reported not as discontinued operations, but rather as other revenues and expenses. The sale of a Nike store, manufacturing plant, or distribution center to another company would not be recorded as discontinued operations, but the gain or loss on the sale would be included as other revenue and expenses, just below operating expenses in the income statement. Now, common examples of other revenue and expenses are listed here. Losses due to the write-down of receivables, inventory, or long-term assets, gains or losses on the sale of long-term assets, losses due to an employee strike or losses due to the business restructuring, and uninsured losses from a natural disaster such as floods, earthquakes, or hurricanes. Exercise 1211. As an auditor for Bernard & Thomas, you're responsible for determining the proper classification of income statement items in the audit of California Sports Group. So it gives us 5 scenarios, and we have to determine whether each item should be classified as discontinued operations or other revenues or other expenses. So one of the company's restaurants was destroyed in a forest fire that raged through Southern California. Uninsured losses from the fire are estimated to be $450,000. A would be, what do you think? Other expenses. B, California Sports Grill has 3 operating divisions: restaurants, catering, and frozen retail foods. The company sells the frozen retail division for a profit of $2.4 million in order to focus on the restaurant and catering business. That would be a discontinued operation. An employee strike to increase wages and benefits shut down operations for several delays at a cost of $200,000. Other expenses. A restaurant waiter slipped on a wet floor and sued the company. He won a settlement, but they've not yet paid the settlement. That would be other expenses. The company owns and operates over 40 restaurants, but sold 1 restaurant this year at a gain of $650,000. That would be other revenues. Let's check your understanding here. So, which of the following items would be reported at the bottom of the income statement just before net income? Would it be A, losses due to the write-down of inventory? Would it be B, gain on sale of long-term assets? C, discontinued operations? Or D, losses due to restructuring? Discontinued operations gets reported separately net of tax right before net income. Next, we're going to distinguish between conservative and aggressive accounting practices. Quality of earnings refers to the ability of reported earnings to reflect the company's true earnings, as well as the usefulness of reported earnings to predict future earnings. Let's move 1 year forward to 2019 for our example company, Federer Sports Apparel. Mr. Nadel, as Chief Financial Operator, which would be the CFO, is responsible for all the accounting, finance, and MIS operations of the business. Now, he's developed a reputation for his very conservative, yet pretty powerful management style. So this slide shown here and next presents the preliminary financial statement for 2019 prepared under the supervision of Mr. Nadel. In this slide, you see the income statement and the balance sheet. Now on this slide, you see Federer's statement of cash flows. After completing the preliminary financial statements for 2019, Mr. Nadel retires, and the company hires a new CFO, Mr. Djokovic. In contrast to Mr. Nadel, Mr. Djokovic has a much more aggressive, quick-hitting management style. Mr. Djokovic makes it clear he's now in charge and some changes are going to be made. So this slide shows some changes he proposes. He wants to estimate bad debts at the end of 19. Mr. Nadel estimated that future bad debts will be 6 to 10% of current accounts receivable. He wants to play it safe and records an allowance equal to 10% of accounts receivable, or $150,000. But Djokovic comes in and proposes changes of 6% of accounts receivable, or $90,000, which changes the increase in net accounts receivable and decreases bad debt expense by $60,000. He also recorded a $200,000 write-down of inventory showing as a loss. But Mr. Djokovic insists the write-down wasn't necessary because the decline in inventory value is only temporary. He proposes eliminating this entry, which would increase inventory and decrease the loss of $200,000. He also proposes a change in depreciation estimates. So Mr. Djokovic thinks that when the building purchased for $11 million in 2018, Mr. Nadel recorded depreciation expense of $1 million in 2018 and 19 using the straight line method over 10 years with a salvage value of $1 million. But starting in 2019, Mr. Djokovic proposes calculating depreciation over a total of 20 years instead of 10 and showing an estimated salvage value of $500,000, which decreases accumulated depreciation and depreciation expense in 2019 alone by $500,000. So change in the estimate here. Then at the end of 2019, the company's lawyer advised Mr. Nadel that there's a 70% chance of losing a litigation suit of $500,000 filed against the company. So Mr. Nadel showed that loss and the contingent liability. But Mr. Djokovic argues that the likelihood of losing that is reasonably possible, but not probable. Therefore, he wants to remove the litigation entry from the accounting records. The change would remove the loss and decrease liabilities by $1,500,000. So this slide presents the preliminary income statement prepared by Mr. Nadel, the effect of the accounting changes, and then the updated income statement prepared by Mr. Djokovic. The four proposed accounting changes cause net income to be more than triple, from $850,000 to $3,110,000. Note that all four changes proposed by Mr. Djokovic increase net income. The reduction in the estimated allowance for uncollectible accounts increases net income $60,000. The elimination of the inventory write-down decreases net income by $200,000. The reduction in depreciation estimate increases net income by $500,000. And then the elimination of the contingent litigation liability increases net income of $1,500,000. Note, the income tax expense did not change because of all these changes that affect financial income, but not taxable income. How do positive changes to affect net income affect the balance sheet? Well, this slide presents the balance sheet prepared by Mr. Nadel, the effect of the aforementioned accounting changes, and the updated balance sheet prepared by Mr. Djokovic. The balance sheet also improves from the proposed adjustments. Total assets increase due to increases in receivables and inventory, plus a decrease in accumulated depreciation. Total liabilities decrease due to the elimination of the $1.5 million litigation liability. Stockholders' equity also goes up due to the increase of retained earnings caused by the increase in reported net income. Well, what about the effects of the proposed adjustments on the statement of cash flows? This slide provides the statement of cash flows as revised by Mr. Djokovic. Interestingly, the proposed changes have no effect at all on total operating cash flows or on overall changes in cash. Net cash flows from operating activities remain at $1,700,000 after the 4 proposed transactions. The net increase in cash remains at $1,500,000. None of the proposed changes affect the underlying cash flows of the company, but rather each proposed change improves the appearance of amounts reported in the income statement and in the balance sheet. Now, Mr. Nadel represents conservative accounting practices. Conservative accounting practices are those that result in lower net income, lower assets, and higher liabilities. The larger estimation of the allowance for uncollectible accounts, the write-down of overvalued inventory, the use of a shorter useful life for depreciation, and the recording of a contingent litigation loss are all examples of conservative accounting. In contrast, Mr. Djokovic represents aggressive accounting practices. Now, aggressive accounting practices result in higher income, higher assets, and lower liabilities. So Mr. Djokovic's lower estimation of the allowance for uncollectible accounts, waiting to report an inventory write-down, choosing a longer useful life for depreciation, and waiting to record a litigation loss are all examples of more aggressive accounting. Everyone involved in business, not just accountants, need to recognize the difference between conservative and aggressive accounting practices. There are actually many gray areas in accounting requiring management judgment in the application of accounting principles. A key point to remember: changes in accounting estimates and practices alter the appearance of amounts reported in the income statement and the balance sheet. However, changes in accounting estimates and practices have no effect usually on a company's underlying cash flows. Let's look at exercise 1215. We'll indicate whether each of the proposed changes is a conservative, aggressive, or neutral stance, and we'll indicate whether the total effect of all the changes would be conservative, aggressive, or neutral. So as you see here, net sales before the change, $18,800,000. After the change, $19 million. So what is happening in this example? Are the changes promoting a conservative approach or an aggressive approach? Well, in this case, the changes are aggressive. In the cost of goods sold, they are showing an increase of cost of goods sold, which increases the expense of $400,000. That would be conservative. Operating expenses are going down. The proposed change would decrease operating expenses, which means an aggressive approach. Revenues in the second one, number 4, would go from $500,000 and we would add $50,000 more to revenues. Again, that's aggressive. Then other expenses were at $450,000. The change would bring them down $50,000. Again, is aggressive. Changes resulting in higher revenues or lower expenses are aggressive. Changes resulting in lower revenues or higher expenses are considered conservative. Which of the following would be considered an aggressive accounting practice? Writing down inventory due to a decline in inventory value, changing from straight line to the double declining balance method of depreciation, deciding to remove a contingency loss when the likelihood of an unfavorable decision is probable. Removing a contingency loss would be an aggressive accounting scenario. Well, guys, you have it there. We have completed this course, and I wish you the very best in your future educational endeavors. Bye-bye.